Why would anyone invest elsewhere when they can double or even triple their money in the stock market? The answer is risk. When it comes to government bonds, for example, there isn't much risk. In fact, it's risk-free to a certain extent. But when it comes to individual companies, there is a risk that the company might fail. It might report negative earnings. Pretty much any negative news can drive the stock price down. The company might release a product, and if the public doesn't like it, that can make some negative headlines, which can drive the price down. So, with higher returns comes more risk. Apple is a well-established company, and its chances to fail are way lower than Tesla, for example. But it also has less room to grow than Tesla. That's why Tesla grew by 721% this year, but Apple by just 70%. What you have to determine for yourself is how much risk you can take without going nuts. If that $1,000 is all that you have left, maybe risking it all isn't the wisest option, because if things turn south, you can end up losing most of it. So one way investors minimize the risk in the stock market is by investing in an index. The most famous one is the S&P 500, which tracks top 500 US companies. So an index fund would basically invest in these top 500 US companies. Some of these companies will definitely fail, but others will grow. Judging by historical data, the average return rate for the S&P 500 since the 1920s was around 10%. This means buying a share of these index funds means you're buying a tiny share in the top 500 US companies.